If you invest 10, the downside risk is actually very low. Whereas the average you can expect between 15, 18 or 20 something.
You mentioned that, when you invest into a stock into the market, you're really dictated by the supply and demand of the market. But when you're investing in a development project, you actually take a raw piece of land, you rezone it, you build on it, you've added construction, you've added brick and mortar, you've added steel. So you're actually adding value brick by brick.
LP is used by hedge fund, private equity firm, the rest, because it's a flow-through entity. That means the profit is not taxed at the company level. It flows through to each individual investor. So there is no double tax problem.
You and I know that physicians and people in the healthcare industry love to invest in real estate. And so this is another episode about real estate investment and different types of real estate investment. Today we're going to be talking about real estate development and how to invest in the type of companies that actually does the development of a property. So we're going to have a deep dive discussion with Joshua on this topic. So I hope you guys enjoy this podcast and learn a little bit about this different type of real estate investing.
How's my financial health, Doc? Welcome to the Financial Literacy Podcast for healthcare professionals, where financial security and wealth topics are not a taboo.
Okay, so welcome back everybody to the How is My Financial Health Doc podcast, and I am your host Vu Ketran. I'm really excited today to have with us another guest. And I don't know if you hear the excitement in my voice. Every time I talk about real estate, my eyes just light up because it's one of those topics I love to talk about. And to be honest, I think most people love to talk about real estate, and physicians are people. So I don't think they're any different from anyone else. And real estate is a very, very cool topic, especially if you live in Canada. And our guest today will tell us why that is. So I want to introduce to you Mr. Joshua Hu. So Joshua, welcome to the show.
Thank you for having me.
I am very excited. I'm very, very eager to learn more from what you do and what type of real estate you do. So let me properly introduce Joshua. Joshua is the Executive Director, East Asia Private Capital Group at Greybrook. Is it Greybrook Realty or Greybrook Development?
It's Greybrook Realty Partners.
Greybrook Realty Partners. And we will dive into that because it's important why the name is like that. Because this is a different type of real estate investment, and we'll drill into that in just a minute. Joshua, tell us, the audience, a little bit who you are, what you do, what is your day-to-day like, and what exactly that you do with Greybrook.
All right. So first, let me introduce Greybrook. Greybrook is a real estate private equity firm. And I'm an executive director. So my job is on the fundraising side and looking after my client, my investors. I run a group of about 7 people. We're looking after more than 1,000 investor household who have invested into our deal. So Greybrook, what do we do? We are a real estate private equity firm, as I mentioned before. We partner with the large scale and best in class developer in real estate development project, and we bring our investor to joint venture with these developers so that we can participate in the development profit. At the same time, we move some of the risk to these developers because we don't want to hold on to some risk, and we can dive into it later. But simply put, this is what we do.
You used a word called private equity. Some of my audience may not understand what that means. So if you can clarify what private equity means, are we buying stocks and bonds and real estate in the market, or what is exactly private equity in relation to obviously your business?
That's a very good question. So in terms of investments, there are several types of vehicle. One is like hedge fund. Hedge fund mostly trade in the mid to short-term investment that you investor can place their asset with the hedge fund manager and they manage it for them. And private equity is another group. They are all alternative investment class. So private equity traditionally it's a fund that invests in company, and they usually buy the company off the listed public market, listed company, and then they restructure it, rebuild it, and sell it later on to make profit. But our company, we specialize in real estate. We are also private equity firm, but rather than buying in company, we invest in real estate project. And because real estate project take time, usually anywhere between 3 to 8 years, sometimes 10 years or more. So we are a private equity firm, like the usual private equity, but we specialize in real estate only. So that's the difference. So it's a long-term investment. Our investor make profit from the development project.
Now, you also used another word. You talk about development project. For me, as a layperson who don't understand this industry because I'm not a developer, so what's the difference between what your company does and a developer such as, for example, Tridel or Mattamy Homes or Great Golf? How are you different in these, what I typically call developers?
We partner with developers. So when you talk about developer like Tridel, like Tribute, like some of these developers, they usually have capital from wealthy individuals or family or company in those projects. So they joint venture among themselves to participate in this development profit. Our company, we come into play when we represent our investor to partner with this developer. We open a way that in the past are not open to the regular investors. So our investor can participate in this deal. So now this developer, rather than partner with their wealthy friends, family, they partner with us. We do project together. At the very beginning of our company, we rely a lot on our developer because they have more experience and capital. We reached a milestone last year when we invested more than 100 projects. So now we actually have more experience and we have more data. We have projects from different stages, from buying the land and to some in the building stage and some exiting stage. So we have very up-to-date information on the market, and we have very sophisticated model built by our colleagues because we have quite a number of them. So now when developers come to partner with us, they actually rely on our expertise because we have a lot more information. For example, a developer might be using a bank for 20 years. They have very good relationship with this bank. The bank try to give developer the best interest rate they think at the time. But because we have so many projects, at the same time, maybe we have another developer just finalizing a loan that we figure out is better in interest and better conditions. We can tell this developer and say, okay, why don't you try another bank? So often we add value in this way.
So let me try to summarize this for the audience. So you guys are working with different developers, and I've named a few of them. So your role coming in is we're going to partner with this developer. We're coming in with data. We're coming in with research. We're coming in with knowledge, and we're coming in with capital to work with this developer. And the developer, his goal is to do the construction, the building of the place, the marketing of the and the sales of the building. When you guys come in with the capital, some of the funds and some of the market data, am I getting it right?
Yes. That's very correct. Yes.
And so if I'm Vu Ket Tran and I'm investing in Graybrook, into your company, I'm investing into a project. And so let's call it project on Queen and Dundas. Let's say that's the project. And it's a building. So I'm investing in your company. You guys are putting the resource and everything to work with the developer. And once the project is completed, then I get my money back. And there's a certain yield and rate and percentage that I get back, which is predetermined before I even invest with you guys on this particular project. Am I correct?
So there is a formula. We call it waterfall distribution. So each project work a little bit different. But for most of the project, the formula is predetermined. So if the project make more money, investor will have more money. If the project make less money, investor will have less money. Everybody will have less money. The formula is predetermined, but not the return. Some project has very high return, and some poorer return. So number one thing we tell our investor is that to diversify, invest in more project. In essence, this is how investors build their own portfolio, their own fund. So we have investor who invested 30 projects. So their portfolio at very stable. There's some very, very good returns. Some are poorer return, but overall the return is very, very good.
Mm-hmm.
So having said that, in the development project, there's a few risk that we don't take, that we do not want to take. We don't want our investor to take. Number one is what we call a cash call risk. Like say, if you and me, we are doing a project, equity needed, let's say $2 million, and if we need more cash, $1 million, then both you and me need to come up with another 500, right? This is called cash call. Otherwise, we need to deal with the share. We need to deal with other things. So, and this is cash call risk. We do not want to take that risk. So we push the risk to the developer. So developer has to come up with all the rest of the financial need. Next one. The second risk is called guarantee risk. So in a project, in a typical project, let's say high-rise condo deal, bank loan, construction loan, a bank usually funds 70% of the project cost. 70%. Another 15%, 10 to 15% is funded by the buyer's deposit. The developer or the investor equity usually only count for anywhere between 5 to 15%. So you can see these are usually the fund, the capital that needed to buy the land and rezone and getting permit. So the front end equity. So you can see most of the capital is provided by the bank. So the bank usually take the land as security, but on top of that, they require the developer to guarantee the loan and often put in collateral. So the developer has to have their own asset and give the bank as a security. Usually 25 to 50%. So our investors do not have to do that. So we don't want this two risk. So developer would take over this two risk.
I'm interested in a project. So you come to me, Joshua, you say, Vu, I'm working on a project. It's going to be built on, like I said, Spadina and Dundas. We're building a building, etc. Here's a project. How do I, as an investor, invest in this project? Is it a fund that I'm putting into? Is it a limited partnership? How do you, when I say you, I mean Graybrook or any company similar to yours, how do you include me as a small investor into this type of project?
First of all, we are registered exempt market dealer, so we're governed by the Ontario Security Commission as well as other province, the Security Commission from other province. And personally, I am also registered in US. We securitize the project that allow our investor to invest in. So when an investor express interest to one of our projects, there are a few steps that we need to go through. One is called KYC, Know Your Client. So we need to do those paperwork. And then there's a few disclosure, they are offering memorandum we need to send to our investor. And then there's a subscription agreement. So we need to sign that, go through all that process. So how we structure the deal is that usually is a joint venture with developer. And this joint venture outside, we set up a limited partnership. And our company, Graybrook, is GP. Our investors are LP, limited partners, including our employee. Like let's say if I invest, I'm also LP. But at the same time, investor can also invest through their RSP, TFSA, RESP. So for them to invest in this deal, we set up a fund we call a mutual fund trust. So it's like a trust. So this trust will hold the LP unit. That way, investor can invest through RSP, TFSA. So if investor invests directly in LP, like under their personal name or under the corp, they invest directly in LP. Whereas if they invest through RSP, TFSA, RESP, LIRA, they invest in a mutual fund trust.
Yeah, I can, as an investor, invest in several ways. So what you're saying is I can invest in this project through my RSP account. And if I did that, it would go into your mutual fund trust. But I can also invest into this project, not through the registered account, but through a non-reg account, at which point I would invest not into the trust itself, but into the LP itself. And so money comes into through two doors, I would say, a direct door through the LP or a separate door through the mutual fund trust that eventually gets into the same pool of money as the LP. And then the GP, you mentioned the GP, which is the general partners. So the general partner, the limited partner, the two pools of money come together with the money from the developer, with the money from the bank, and then off goes the project. Am I understanding it correctly?
You're correct. You're very correct. But usually, it depends on the project. The bank money may come later, because the first equity is usually for land purchase, and then we might use the bank line of credit for some of the soft costs. Construction costs actually come a few years into the project when we have sold up to maybe 60-70% of pre-construction. Then we start to borrow money from the bank for this construction loan.
Typically, the purchase of the land is made by the GP, the general partner.
The purchase of land is purchased by both parties.
Got it.
The developer and the LP, but sometimes the land come to us. Sometimes the land goes to the developer, like the sourcing of the land. We partner to date with over 20 developers, but there are a few, like say 5, 6, 7, that we have partner in many deals. This developer, they see deals all the time, and we see deals all the time too. So we actually have a lot of deals coming to us. We choose the one that look better, more profitable, less risk, and then we go through our due diligence process. If the land come to us first, we will choose which developer to partner with. If the land came from the developer, then obviously that is the developer that we partner with.
So typically, private equity firms like Graybrook and other real estate private equity firms, what type of development are we talking about? What type of real estate? Is it mainly is it mainly residential? Is it commercial? Or it's all sorts?
We only do residential development. Some of that residential development has some commercial portion, but very small portion. So we do high rise, low rise. We do land development. Most of our deal are close to GTA. We also invested in US too. In US, we have apartment development deal. So multifamily apartment, income producing property. And we also have this value add project. So we will purchase a portfolio of multifamily unit. We will renovate it and we will boost the NOI, net operating income, and then we sell it. So we do that too.
That sounds really wonderful. So what that means is me as an investor, instead of me going out and buy a house and renovate it, I could do the investing through you guys. And it sounds like your company plays in different types of real estate investment. So you do high rise, you do mid rise, low rise, you do multifamily. So I, as an investor, can choose different types of investment deals that I want to participate in. Is that correct?
That is correct. That is correct. We usually have about anywhere from 4 to 6, sometimes 8 deals a year. We don't know how many deals we can do in a year. So they come to us. We only do the deal that pass our due diligence process. So sometimes they're more, sometimes they're less. Investor will need to take a few years to build their portfolio.
So let's come back a little bit because we use a few words that may be foreign to us. The word general partner and the word limited partnership. Can you maybe just simplify for us the difference between a general partner and the difference between a limited partner? Obviously, me coming in as an investor, I'm coming in the limited partner portion of the deal, and the general partner is Graybrook and other people. So what's the difference and who are these people?
Before that, I want to explain why most of the investment vehicle using LP structure. So LP is used by hedge fund, private equity firm, the rest, because it's a flow-through entity. That means the profit is not taxed at the company level. It flows through to each individual investor. So there is no double tax problem. So let's say if you invest in a listed company has to pay tax first, then listed company distribute dividends, then investor has to be taxed again. So this is called double taxation. Whereas LP is a flow-through entity. So when the development project make money, it flow through directly to LP. So at the entity level, LP entity level, there's no tax. So in an LP, limited partnership, there are GP, general partner, and limited partner. So limited partner are the investor whose liability is limited to the to the capital they invested in. Let's say this LP invested $10 million, but borrow $100 million. GP will take the liability of GP's unlimited liability. Okay, but the investor only responsible for the capital they put in. So this structure is protecting the investor. So, and that's why it's used very commonly in the alternative investment world.
The limited really stands for limited liability. So I, as an investor, I decide to put in this project. I want to invest in this project, and I put in my $10 as an example. And so if the project makes money, my $10 may become 12, may become 15. That's great. But if the project really goes south and we lost everything, and everything goes up in flame, I only lost $10, not more.
Correct.
But
that is correct.
But the general partner, well, they may lose more because now they owe the bank money. There's different things. There's different potential liability issues, lawsuits, et cetera, et cetera. So the general partner, as you mentioned earlier, has unlimited liability because they are fully on the hook. Whereas the limited partner is only, the liability is only what you have put in. So if I put in $10, I can obviously make money, but if I lose money, I only lose 10 and not more. There's no one else chasing after my house, chasing after my car.
That is correct. That is correct. So usually, the GP will use company structure to be the GP, because company is a limited liability company to limit their liability. But in the structure, GP's liability is unlimited.
So typically, the GP are the people bringing forth the project. So in a project A, limited partnerships are the different investors, and then the GPs would be, let's say, Graybrook and the developer together. These two corporations would be the GP. Am I correct?
In our deal, only Graybrook is GP usually.
Oh, okay.
So we joint venture with the developer. So developer do not belong to this partnership, do not belong to this LP.
Got it. So in your deals, the general partner is Graybrook, and the limited partners are all the other investors participating in this project.
Correct, including our own employee, and sometimes including the developer's employee.
Right. Because also they can join the project also as investors inside this LP.
Correct.
Got it. Thank you for clarifying that. So you mentioned that this is a flow-through structure, meaning that the money that comes in, the profit that comes in, is flow through, and then it goes to the investor, and then so the investor is now responsible for paying the taxes, only one, because there's no double taxation. So when that happens, when we invest in a limited partnership type of investment, especially in real estate, is this considered passive income? Is this considered active income? How is it defined? Help me with that.
This is considered as active income for most of our project, development projects, especially in Canada. Like say we buy a piece of land, we build condo, and we sell condo. Those are active business. So the income is considered as active income, active business income. So a lot of our investor, if they are running a company, they can use the company retained earning to invest in our deal.
I put in $10 and I'm invested in this project A. 5 years later, I've got a return. It's now $15. So I made that extra $5. So that extra $5 within this deal is considered active income.
Yes, if the deal is a development deal, that means buy a piece of land, build new building, and exit. But if it's a value add deal, then it will be considered passive income.
Oh, okay.
Active value added deal means we buy existing building,
yes,
we renovate it, collect rent, and sell it. So those will be passive.
I guess I have to read the offering of memorandum carefully to understand that when I have my $5 back, how is that $5 being treated? And so when I get that money back from Graybrook, is there a tax slip, a T4, a T5, a T3, or whatever T's there is for me to submit to CRA to say, this is the type of income I have made from this deal?
Yes. For one, I would say 90%, 95% of our income of our project are active business income. So most of them. And we will send our LP investor, LP partner, T5013 every year. T5013. On that form, there will be all the numbers that they need to file tax return. For the first few years, usually it's negative because we can count some of the spending as expense, so they can flow through to the investors and they can deduct the income from the other places. But for the investor who invests through RRSP, TFSA, there will be no tax because there is no no need to file tax.
Thank you very much for explaining that. I was always wondering how things were being submitted to CRA. And so you mentioned these value add deals where you buy, you renovate, you rent out, and then you sell afterwards. And I know that some of us have most likely watched some YouTube and try to understand the real estate and say, I could do the same. I could buy an old house down the street. I'll buy it. I'll renovate it. I'll refinance it, and then I'll rent it, and I'll do the same. What we call a BRRRR. How is your project different from what I'm going to do in a BRRRR? Obviously, if I'm doing in a BRRRR, I'm doing in one house at a time. The way you guys do it, you're doing multi units at a time. Am I correct?
That's correct. That's correct. So I would say, in principle, they are quite similar. But if, let's say, you do it yourself, you take all the risk. And when you do a BRRRR, if you do it properly, you need to let the bank know, okay, I'm going to tear the house down, and when you build it, you have mortgage risk, interest risk. Like now, interest rate is very high, so I guess you want to refinance, but when you build it, your value may not up to where you expect, then you might lose money, right? Otherwise, you have to sell it. So I would say one big thing is the risk. In our investment, our LP has limited risk. They don't need to worry about those problems. And the second is that our company and the developer, we're working for our investor. So someone is doing on behalf of, obviously, our company and developer, they make the money from doing this. One of the biggest difference is that the value add project that we do, they usually are very big, a portfolio of a few hundreds to thousands of units. And for us, let's say, to add value, what we do is we can renovate, let's say, the lobby. We can change some of the system, let's say, make it more efficient, like the power, less hungry, like more green. A lot of the rental in those apartments, they are paying below market rent because of the rent control, if we're talking about the Ontario or the Quebec. So whenever one leave, we can renovate it, and then when the next one come, the rent is going to jump by quite a bit. So over time, we tune over the rental, and the NOI will go up quite a lot. I would say the renovation on those units will cost less per unit compared to if we do it ourselves.
When you're doing hundreds and thousands of units at a time within a building, you definitely get economies of scale. That's your first profit there, right? How is this also different from a REIT, for example? How is your development projects different from me putting money into a fund, which is a REIT? How is that different? Please help me understand that.
REIT, real estate investment trust, they make money from two ends, usually from rent, right? The business is collecting rent. And the second is they make money from capital gain. When we do development, what we make is development margin. Whereas a REIT, they make money mainly from the rent, and they need to distribute the rent next to 95% of the rent, and the rest are capital gain. When there is not enough capital gain, the return on REIT is going to drop, which makes sense because the risk there, you already finished the building, so there's not much risk to hold there, and the only risk is to collect rent, basically. So there is an investor cannot really expect a very high return from REIT. But in the past, like say 10 years, there's a lot of return, a very good return. Development, on the other hand, we make development margin. It is a very simple business. We know how much money, how much, let's say, what's the price a condo can get today. We know what's the construction cost, and we just need to factor in the land price and the other costs. We know if we do this project, how much money are we going to get to make the margin? And this margin didn't change much in these years. Yeah, a little bit, not a lot, because developer has to make money, has to make margin. When the margin drop to a certain number, it doesn't make sense. The bank is not going to lend money. We cannot build. This margin usually, let's say high rise, is anywhere between 15 to 20 something % on cost. So let's say if today's house, if house price today is 30,000 one house, for a developer to build that house, they want at least 20% margin. Let's say 20% margin. If this house today is 300,000, the developer still want about 20%. Now, if the house is $3 million, the developer still want to have 20%. Otherwise, it doesn't make sense to build them. Whereas, as an investor in real estate or stock or anything, when the price is low, the risk is low, 30,000, right? Go to next 300,000. But when 300,000 go to $3 million, there's a huge jump. Now, let's say house is already $3 million. Do you want to buy it or not? The risk is getting higher and higher. Whereas for developer is the same, because I need to sell this money. Let's say I need to sell it for 3.6 million. If my cost is 3 million, if someone buy it, then we build it. So we make development margin. It's a margin business.
Right.
And when the price is not there, developer cannot build. Let's say today, if we look at today's situation, interest rate is at like 5-6%. Residential mortgage is at 5-6%. So the resale market dropped because it's harder to get mortgage. But the pre-construction unit does not drop a lot. It cannot really drop much, and most developers do not drop, because if it drops, the margin is squeezed, then the bank is not going to lend the money. So the project will be canceled. So you're going to see more canceled projects because they cannot build. And when they cannot build, what happened is that the supply in the market reduce by quite a bit, die off. Whereas, in city like Toronto, the demand is getting up. We have a lot of new population here in this country, in the city. So the demand going up, supply dropping. In about 2 years' time, 1, 2, 3 years, something got to give. So either the price go up, the cost come down. As a developer, we still need to make the margin. If we control our costs, when the price go up, our margin get bigger. But it cannot be lower than certain percentage. Because if it lower than certain percentage, we can't build, and there will be no supply on the market. The project get delayed, and we may make it next year.
So I think you said something that is really important that I never realized. And thank you for saying it, because it never occurred to me that if the developer does not make that margin, the bank will not lend money, because the bank does not want to take that risk. I've never conceptualized that, but thank you for saying it, and it actually makes sense. If the bank doesn't lend the money, the developer doesn't build, there's less houses to be built, there's less supply, therefore the prices in the market will go up. And then at which point the developer will start building, because the margin is there. And the bank will start lending again. So absolutely makes sense. Thank you for explaining that.
No problem. We actually see this happen a few times. The first time in 08, 09, because when 07 crashed, 09, 010, then it bounced back very quickly. We have a project. We shut down the sales office because it's not selling. And when we reopen it, in 2 months, we sell a year worth of product, 1,600 condo in a very short time. We see another time in 2020, the beginning of the 2020, just before pandemic hit, because of the B20, the market drop, resale market drop. In 2019, the low rise is house. The resale is dropping, the pre-construction is not selling. But then 2020, it bounced back. So now today, the market come down again. You know what? The history bound to repeat itself. So we're going to expect either the price go up or the cost drop down.
Absolutely makes sense. The law of supply and demand still makes sense. Even with COVID, still makes sense. So give me an idea. You mentioned it earlier. If I were to invest in a REIT, we're generally looking at, returns of maybe 7 to 9% because it's based on rental income, right? And so an investment into a company like yours, where it's development, you were talking about 15 to 20%. Am I right?
Yes. Well, the unit we use is usually average annualized return.
Yeah.
So like say $1 in, $2 out in 5 years, that 20% annualized. How I tell my investors are set expectation at around 15 to 18% annualized return, average annualized return, and then build a portfolio around it. So because if you invest in one deal, sometimes it's very high, 50% average return. Sometimes it's single digit, but it depends on the time of the market. But usually, if you invest one, it's 15 to 18. If you invest 10, the risk, the downside risk is actually very low. Whereas the average, you can expect between 15, 18 or 20 something.
So when you look at that type of percentage annualized return versus what you get on the market is definitely almost double of what you get investing in S&P 500 bonds, et cetera, et cetera. So help me understand why such a huge difference.
Yeah, there's a few reasons. I would say, first of all, the most of the investment on the market, like say stock, you make money by the market, basically. You buy stock to $1, tomorrow become $1.5 because someone buy it. So the demand supply of the stock itself push up the price. Whereas we, as a developer, like say, investing in development projects, we make money from doing the work, actually, doing the work itself. We sell pre-construction units and then we build them. It's like we make wages. More importantly, there's another concept we call illiquidity. Private equity product, it get locked down 7-10 years usually. Our one, it depends on the project. Sometimes shorter, sometimes longer, depending on the project. So this illiquidity demand higher return. Like say stock, you can sell the stock tomorrow and you can get your money back, right? So this, we call it liquidity premium. Something can be sold quickly and turn into liquid cash, usually has lower return because the liquidity is very good. People pay liquidity premium so that they can use it when they need it. Whereas our investment, once investor invest, in 7 years, you can't do much. So this is illiquid. It can be good thing against some investor sell at the wrong time, buy at the wrong time.
You mentioned that, when you invest into a stock into the market, you're really dictated by the supply and demand of the market. But when you're investing in a development project, you actually take a raw piece of land, you rezone it, you built on it, you've added construction, you've added brick and mortar, you've added steel. It's actually, like you say, building a widget. So,
Yes.
so you're actually adding value brick by brick. At that
Yes.
point, it's no longer a supply and demand issue. It's a quality of work. It's the value that you've added to the piece of land, which I think, in my mind, adds the value, why you can command a better return, because it's no longer just a question of being dictated by the craziness of the market.
That's correct. There is a advantage in that we actually sell before we build. So we don't really need to spec it. We're not speculative building. It's just like in all pre-construction unit, we sell before we build it. There's already buyers before we actually spend big money on it. So that's a very good risk reward strategy. It's like you want me to do something for you, great. Pay me the money. We agree a price, then I start working. So developer basically doing business. So it can be like, as you said, widget, but someone already bought it, then we start building it.
Right.
It's a good feature.
Right. So for those of us who run businesses, it's essentially a purchase order.
Correct.
Right. So I'm gonna pay for something that you're gonna deliver later, but I've already paid for it. And so for the developer, there's much less risk that way.
Correct.
So now let's end this by talking a little bit about some of the risk, because we've talked about a lot of good things and you've explained a lot of concepts to us already. And I'm not particularly talking about Graybrook here and your company, but other companies that do real estate development, such as yours. If I was an investor, what type of risk should I be looking at, and what type of risk should I be assessing? And not specifically to your company, but just this type of investment in general.
Okay. Number one risk is the execution risk. If let's say if the audience want to partner with someone experienced is very important. Someone's balance sheet is very important. Someone who does not need money are the one who actually you want to partner with. Someone short of money, not the person. So that's one. The second one is the leverage. Most of the real estate developer fail when they take on too much debt. That means that the leverage, it need to make sense. There need to be a risk reward balance. If someone borrow too much money, something happen, the market downturn, they can't stand, they will fail. Whereas if some developer has a lot of very strong balance sheet, a lot of cash, then even if the market fail for 10 years, it's fine. Leverage is pretty much up there. And I would say doing development in Canada, in Vancouver, I heard too, time is one thing. So the city approving the permit these days are getting longer. So this is one of the risks. So what happened is, let's say, if you expect to make 100% in 5 years, it get delayed to 6 years, then your 100% divided by 6, the annualized return is coming down. One other risk, which I think is getting subsided, so it's not, I think it's coming down, is the construction cost increase, the risk of construction cost. It's dropping. Actually, we see, because we have so many projects on the go at the same time. So, and we give our investor 2 unit holder report a year, so we see them real time. The way to deal with construction risk usually once you sell the unit, you build it as soon as you can. So maybe 6 months time or 3 months, so that you're in the same period. In about 3-4 years, like 3 years from before, this 3 years, we see a lot of cost increase, and we see a lot of the canceled project on the market. A lot of them is because they sold the unit, but the cost increased too much. So that's one risk. But on the developer side, the risk the reverse. If you haven't built them, you can sell the land and demand higher return. You don't even need to build it. So this construction cost risk is another risk. Interest rate risk is real, especially today. In a few years ago, like let's say 2 years ago, the rate is so low. As a developer, when we look at the development project, interest rate is a cost. It go down to cost, just like your brick and mortar, your windows and all that is a cost. It will go up, but it's not like a REIT. So a REIT, when interest rate go up, the rent might not be enough to cover the interest rate. So it is more like a business for them. But for us, in a development project, like I said today, this 2 years, when we do our pro forma, we model interest rate. We have a model, and if we go up certain way, we have our own assumptions. So we will put in a higher assumption into our pro forma, and this is just a cost to us.
Yeah,
It is one of the costs. we also do something about it. The closing risk. Closing risk. We have a lot of projects on the go, some close. A lot of projects when it's sold 2017, 18, 19 even, today they're in the money. Like say we sold like 500,000 a condo. Today market price is 600. And even if someone cannot close due to mortgage problem, no problem. We take it back, we sell it at 600, right? So that's not a problem. The problem arises when we sold at the peak of the market, like say 2021, 2022. We sell, like say, a house for $1.3 million, and now it become 1.1. But we haven't started building the house because it's closing in 2 years, 1 year. Those are the risks. What we do is that we call them one by one and find out whether there is intention to close. We actually proactively work with our buyers on a case-by-case basis to minimize those risks. So this is a risk now, but because we're staying ahead, and maybe in 2 years market go back up, they have no problem. But even today, if let's say we know there's a problem, maybe we can choose not to build the house, or maybe we can choose to delay building the house, depending on individual buyers.
Got it. So you'll work with your buyers to make sure that there's a win-win for everyone.
Correct. That only apply today. I mean, if it's like 2 years ago, nobody would do that. But today we see there's a risk there, so we do something about those risks. Yeah.
Well, listen, Joshua, this was very, very comprehensive. You know what? I've learned so much today. I think I can do your job. I don't think so. I don't think so. I don't think so. There's still so much to learn. But you've given us so much today. A lot of good information. And a little bit of the back of the scenes, the back of the curtain of this business. And my goal really is to make sure that my audience understands there's many ways to play in real estate. There's many ways to invest in real estate. And the one that your business in is definitely very, very attractive. And I'm also happy to see that, successful companies like yours are mitigating all the risk possible. Obviously, you can't mitigate all risk, but that you attempt to mitigate risk, which is very good for the investor. So I'm very, very happy to hear this.
Great. Thank you. Thank you. So, and if any of the audience like to know more, I mean, feel free to reach out to us. I would say our best type of client, those who do not like to speculate on the stock market, who does not want to look after a rental property and the tenant and etc. So our investment is pretty hands-free.
That's good. That's good, because many physicians have their hands tied up already. So they definitely need to have some sort of hands-free investment. And this sounds like a very, very good option. Thank you very much again, Joshua.
Thank you. Thanks.
Well, I really hope that you guys enjoyed this podcast. I've had a really fun time chatting with Joshua. And it sounds like this type of real estate investment is probably easier than investing in pre-con, but they have very much similarities. For the very busy physician and practitioner, this is one of those options that one can really entertain if we really wanted to jump into real estate investment as a way to diversify our investment portfolio. Again, thank you very much for listening this far. I hope you have really enjoyed this podcast. And if you have, please share it with your friends, your colleagues, your dogs, your cats, and don't forget your pet turtle. If you have any comments to leave for me or any feedback, please email me at hmfhd2020@gmail.com, and I will see you guys next time.
How is My Financial Health Doc podcast is hosted by Dr. Vukit Tran. Dr. Tran is a physician with a special interest in personal financial security and wealth education. Dr. Tran does not render or offer to render personalized investment or tax advice through this financial podcast. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. Please confer with your advisor, lawyer, or accountant for specific advice.